Welcome to Fear and Greed, business news you can use today. Some of Australia's best-known companies are among the worst-performing stocks on the ASX 200 over the past year, while the miners have been among the best in 2025. Fear of rate hikes slams the local housing market, and the Defence Department warns Australians about unexploded bombs ahead of the holiday period. Plus, Communications Minister Anika Wells under more fire over travel expenses, and Netflix buys Warner Brothers. It is Monday, the 8th of December 2025. I'm Michael Thompson, and good morning, Sean Aylmer.
Where'd the November come from?
I don't know.
That was very left field.
Sometimes it's a miracle if I even get my name out. Right, Sean? I don't know.
So, for listeners out there, it is Monday, the 8th of December. The main story, Michael, take it away.
Oh, sorry, I got distracted by the unexploded bombs story. It was we've got some good stuff coming up. The main story this morning, Sean, the materials index, including the big miners and the gold companies, has been easily the best performing sector on the ASX over the last year, while healthcare and the tech indices have been the worst.
A total turnaround from last year when miners outside gold could find very few friends, while tech stocks could find very few enemies. Over the past year, though, the materials index on the ASX, which includes the big three miners and the gold stocks, it's up 21%. The tech index is down 21%. Healthcare is off 22%. Now, the healthcare is a much smaller sector, and because CSL has done so poorly, that has dragged that one down. Financials, always interested in that. 25 to 30% of the market, driven by the big banks. Lackluster year. The index flat. Commonwealth Bank's down 3% over the past 12 months. It's very much weighed on the financials. The best performers have been the gold stocks: Regis Resources, Resolute Mining, Genesis Minerals, Evolution. In fact, 8 of the top 10 performers so far this year are gold or gold-related stocks. And that's thanks, of course, to these record gold prices. Mm-hmm. But even the other miners, Michael, BHP up 10%. Fortescue Metals, Rio, both up 15%. Some of the other better-known companies away from the miners generally: Harvey Norman, great year, up 50%. Challenger, 48%. Telstra, up 22%, and pretty good dividend as well. Transurban, up 15% or thereabouts. The best performer on the market, though, Michael, not on the ASX 200, the whole market.
Okay.
A gold tiddler called Dateline Resources. It is up 8,233% over the past year. It was 0.003 cents a share. It's now about 25 cents a share. In fact, it was one point it was up to about 60 cents a share. So presumably it was running at about 20,000% or something. It's come off since then.
Oh, to have a crystal ball, huh?
Yes.
That's quite something. Not exactly a household name, though. What about the flip side to all of this? The worst performing stocks over the past year.
Actually, I think this is where it gets interesting, because many of the worst of the top 20 are really well-known companies, but it's not like there's a theme through them. Like all the strongest performers are gold stocks, clear. Worst performer, Reece Plumbing. Second worst performer, Treasury Wine Estates, Guzman y Gomez, James Hardie, Premier Investments, WiseTech Global. Bunch of reasons: poor performance in the US, corporate governance issues, sell-off of assets to overvaluation previously, all that sort of thing. But I cannot remember a year when the worst 6 stocks on the ASX 200, the 6 I just mentioned, were household names. The worst 25 of the ASX 200. You can throw in Domino's and CSL and REO in Bendigo and Adelaide Bank, Flight Centre, Goodman Group. Quite amazing how many high-profile companies have done really poorly over the last 12 months.
Yeah, and big, like CSL. Like that is quite extraordinary.
Goodman.
Yeah.
Incredible. WiseTech Global. Yeah, absolutely.
All right. Well, what can we expect? That's looking back. What can we expect today from the share market when it opens this morning?
Futures trading suggests the market will start lower, even though Wall Street was slightly higher over the weekend. A big week in the local market with the Reserve Bank meeting today and tomorrow, while no one expects a rate change at the announcement tomorrow. Plenty of interest in what Governor Michelle Bullock will say about inflation and the future trajectory of rates. Bond markets are pricing in a rate hike before the end of 2026. Also, the US Fed meets. It's expected to cut interest rates by 0.25 percentage points. The world's most important central bank cut last month, though there was a difference of opinion about whether they should or shouldn't between the Fed governors, so that will be carefully watched this time around.
The fear and greed the week ahead. I couldn't. Okay, Sean, I'm having a shocker.
It's a tough morning.
I have so far lost track of the month that we are in. I've lost track of the podcast that comes up straight after this, which I recorded with Stephen Koukoulas, our resident economist. I should know it. We are talking about the week ahead, so we dig into all of those things in terms of the RBA meeting, the Fed meeting, but also the labour force figures that come out on Thursday as well. Something to keep an eye on. That's coming up after the show, so stick around for that. The housing auction market, Sean, has been given a bit of a dose, a bit of a taste of what higher interest rates could do, with the preliminary auction clearance rate falling to its lowest point in a year.
With expectations growing that the Reserve Bank has stopped cutting rates and fears that it may lift borrower costs next year, the market, which has had a pretty good spring, hit a wall. Just 63.5% of homes that went to auction across the capitals last week were bought, down from 68.3% a week earlier, well over 70% last month. Sydney's result was particularly poor, 61.5%, Melbourne 65.5%, Brisbane 55%, Adelaide 71%, which was actually pretty poor for that city. Volumes were lower over the weekend, and basically they will keep tracking down the volumes according to Cotality. It's just whether or not it's probably overstating it saying dire preliminary clearance rate, but fairly poor given what we've seen in the last few months.
I'd say dire by comparison. I think.
Yeah, okay. I'm happy to go with dire. Good.
I never shy away from melodrama, Sean. Anyway, we are going to take a quick break. I'm going to have a cup of tea, get my head together. Back in a moment with the rest of the day's business news. Sean, Communications Minister Anika Wells is under the gun over her use of public funds to take trips both locally and abroad, but she does insist that she was working hard on all of the trips.
Yes. Even the Prime Minister, Anthony Albanese, fresh from his honeymoon, had to defend her travel expenses yesterday. Wells has been under scrutiny since the cost of the trip to New York for her and two staffers came in at $100,000. There were then reports she flew to Europe 3 times in 2023, 2024 at the cost of almost $120,000. The Fin Review then reported an Adelaide trip that included a friend's birthday, a cost of $3,681 for flights, hotels and chauffeur-driven transport. While yesterday, the Sydney Morning Herald said Wells billed taxpayers $1,389 for her husband and 2 of her 3 children to join her on a work trip to the Thredbo ski fields. I get that politicians work very hard. I think, and I feel sorry for them the time they're away from family, but pub test? Doesn't pass it. Wells insisted yesterday she'd been working hard on all the trips and that they were all necessary. Albanese told ABC's Insiders program that Wells had operated within the rules, at least when came to the New York trip.
Yeah, and this feels like one of those things that once there is an element of this being reported, more do tend to come out. There's then the $1,800 to attend the F1. It's not looking good. And you feel a bit for the Prime Minister as well, coming back fresh from his honeymoon and having to. That's the last thing you want, right? To step straight into controversy. I
reckon even when you're a Prime Minister and you get back to work day one, which he did yesterday, you must just think, oh, really?
God. When can I book my next trip? Sean, the latest opinion poll, this would at least be some good news for him, right? The latest opinion poll, this one's in the Nine Entertainment newspapers, says that support for the coalition has crashed to a record low and support for One Nation has hit a record high, which is now becoming a familiar story.
It is. The Resolve Political Monitor showed Labor has a commanding 45% lead in a two-party preferred vote. Also showed that fears over Australia's housing crisis and the cost of living are fueling frustration over immigration, something that I'm sure the government will keep an eye on. Labor's primary vote rose 2 percentage points to 35%. Coalition fell 3 to 26%. One Nation rose 2 percentage points to 14%.
The energy market regulator says households should pay lower electricity prices between 2025 and 2030 as long as the energy transition continues along the government's planned path.
The Australian Energy Market Commission said the build-out of renewable generation, transmission and battery storage is essential to keeping electricity prices affordable over the next decade. The good news is that the regulator's base case is that prices will fall around 5% over the next 5 years, supported by renewable generation growth. However, if there's any slippage at all in the rollout of renewables, battery storage and transmission, then households could face sharply higher prices. It called the next 5 years a critical 5-year window as renewables replace retiring coal-fired power plants. We kind of know that, but just the fact that the regulator, which is probably the most sensible voice in the market, is not political, saying if we can do what the government has set out to do, we should be okay.
Now, ChatGPT owner OpenAI, Sean, will become the major customer of a $7 billion data centre to be built by NextDC that will be the biggest in the Southern Hemisphere.
This is exciting.
Yeah.
Come on, Michael. No.
It is. It is. I was actually just thinking, though, that those two stories actually do kind of fit together because the data centres and the increase in the number of data centres, especially one as big as this, it uses so much power.
So much energy. The data centre will be used to run the artificial intelligence models, tasks and queries of the growing number of OpenAI's Australian corporate clients. Now, some of their corporate clients, big names like Commonwealth Bank, Wesfarmers, Fortescue, Virgin Australia, Atlassian. This is all according to the Fin Review. The centre will be located in Western Sydney and is part of Australia's push to become a regional hub for data centre investment. Already happening to some extent, as demonstrated by the surge in business investment in data centres during the September quarter. OpenAI's chief executive, Sam Altman, said Australia is well placed to be a global leader in AI with deep technical talent, strong institutions and a clear ambition to use new technology to lift productivity.
Mention this next one at the top of the show, Sean. The Defence Department has urged the public to stay alert to unexploded ordnance devices, some of which will date back to World War II. Now, when we received this one late last week, it raised a few eyebrows because I don't remember ever seeing a warning like this come through from Defence.
No, I don't know. You pointed it out to me because very interesting. So the Defence said that unexploded ordnance devices, UXOs, continue to pose a risk to the communities around Australia, particularly when disturbed or moved. Like, you see an old grenade, don't throw it. I think that's what we're saying here. UXO is most commonly found on or near former defence sites, demolition ranges, fair enough, but also washed up on beaches. That's one of the issues. The warning comes as summer holidays begin, of course. Defence wants people to be particularly careful in areas with a history of military activity or following storms. Defence have responded to over 450 calls regarding unexploded ordnance devices this year. As Defence puts it, UXO include artillery shells, grenades, bombs, or other military munitions that did not function as intended when deployed. If they were deployed in World War II and they haven't exploded yet, I think it's fair to say they didn't actually do what they were supposed to do.
Yeah, I just love the fact that we are now supposed to put this on the list of things to watch out for when we go to the beach. Just keep an eye out for blue bottles.
Sunscreen.
Unexploded ordnance devices. Check. Mm-hmm. Yep. Turning to international news now, Sean, big story, this one. Netflix is set to buy Warner Brothers in an $83 billion US deal, beating out Comcast and Paramount and really demonstrating just how much Hollywood and big tech are really starting to merge.
So you sent me a story about this, and the guy who was running Warner Brothers 15 years ago kind of poo-pooed the idea that this mail-out movie company called Netflix would ever have, it would ever be a challenger to the great Warner Brothers.
Yeah.
Well, now Netflix is buying Warner Brothers.
Yeah.
Dramatic plot twist for Netflix.
Well done. Yeah.
Yeah, because they rewrote Hollywood because they basically just told people that they didn't have to go to the cinemas anymore. You can watch movies at home, watch television shows at home when you want them. Suddenly, the thing it disrupted, it's now bought a mainstream studio. Netflix, it's been all about building stuff. So Stranger Things, Bridgerton's, a film like K-pop Demon Hunters. Haven't seen that one, Michael, but I'm sure you have.
Yes, of course. Yeah. Anyone with young kids in their household has seen it multiple times.
Yeah. So they've built those sorts of shows. Now they're going to gain access to Warner Brothers' trove of content. We're talking things like Game of Thrones, Harry Potter, the DC Comics roster of superheroes, including Batman and Superman. According to Reuters, the deal still needs regulatory approval, lots of debt involved, not quite clear where the synergies are, particularly Until now, sort of Netflix has been about building, not buying products. Even its CEO, Greg Peters, has spoke about that 2 months ago. But the intent is clear. Now, what this means for moviegoers, I reckon that's anybody's guess, because Netflix is the arch enemy of moviegoers, or cinemas, and Warner Brothers, of course, is a business built on moviegoing. I suppose it's a bit like when Jeff Bezos bought the Washington Post.
Yeah, and
like a similar.
And look, there has been a commitment. Well, that Netflix has said, hey, we are still going to be doing theatre releases, but Netflix has in the past done limited theatre releases where it's a small kind of release rather than the full run of screens right across the US and across the world. And there's a lot of concern in Hollywood now that maybe it might be a lot more limited theatre releases. And we saw on Friday that a lot of the US theatre chains like AMC Entertainment and IMAX were all their shares were down kind of as much as 8% on Friday because of that.
Yeah,
Big concern.
Think, yeah, I mean, and it still has to get through lots of regulatory hurdles, but really interesting.
Yeah, it certainly is. Anyway, up next, Fear and Greed Q&A. It's the week ahead with Stephen Koukoulis. It's coming up in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. Thank you very much, Sean.
Thank you, Michael.
It's Monday, the 8th of December, 2025. Make sure you're following the podcast and please join us online on LinkedIn, Instagram, X, TikTok and Facebook. I'm Michael Thompson and that was Fear and Greed. Have a great day.